Well, good morning and thank you for joining us at our webinar this morning. My name is Jenny Wilcock and along with Terry Dewing and our wonderful team, we run Sullivan Dewing Chartered Accountants and Business Builders based in Caringbah. Today we are hosting our annual economic update. We had been expecting to see you face to face this year, but not to be. So thank you for joining our Zoom. This morning, we welcome our external panellists. We have Craig James from CommSec. We also thank Stuart Carey, CBA Executive, Manager of Commercial Banking Sydney South, and also Joel Curtis of Endeavour Wellness and Sutherland Shire Chamber of Commerce. Before we start, I know I've already had a lot of questions submitted to me, but if you guys have any questions at all, please just post those in the Q&A or the chat box at the bottom of your screen, and we'll get to questions at the end of our presentation. So here we are, late July already. Once again, we have been turned upside down by COVID. And certainly my team at Sullivan Dewing, we are working so hard to apply these much needed support packages to all of our clients. And we are certainly well underway, and I can assure you if we haven't applied them to your business as yet, we will be with you very shortly. The grants and the JobSaver packages are open for some time yet, and we will make sure that you get the grants that you need to keep your business going. We're certainly expecting some further announcements from our New South Wales Premier today, so we'll wait to see what they are and cross our fingers that there is support that will follow us right through this pandemic. So we have had a huge response to our webinar this morning, hundreds of people wanting to attend. So thank you for that. And we certainly know that everybody's very interested right now in where our economy is at and what's on the horizon. We are joined today by many members of the Sutherland Shire Business Chamber, and we welcome you this morning. I would like to introduce you now firstly to Joel Curtis. Joel this morning is representing the Sutherland Shire Business Chamber. And he'll brief us on the Chamber's work in our business community. Joel is the owner and principal psychologist of Endeavour Wellness. Joel holds a master's degree in sports psychology and has been running his business in the Sutherland Shire since 2009. Well done, Joel. Joel is passionate about supporting people in their life and their business. He is involved in several local networking groups and has a strong focus on building connections in the Sutherland Shire. As a board director, Joel loves the opportunity to increase chamber membership and help people find the connections they need to make their business successful. Over to you, Joel.
Thank you very much for the introduction, Jenny. I appreciate it. And thank you very much to Craig for his time this morning. I'm certainly looking forward to his economic update. Just wanted to say also thank you to Jenny and the team at Sullivan Dewing for putting this event on. We certainly appreciate the opportunity in these uncertain times to get some support and some information. And obviously, I'm a little bit biased because Jenny's my accountant, so I certainly appreciate her services, especially during these uncertain times. So I would suggest it to people that if you haven't reached out to your accountant to do so, and obviously make sure you're touching base with the team at Sullivan Dewing to make sure that you're getting all the support you need during these uncertain times. The Sutherland Shire Business Chamber represents local businesses within the Sutherland Shire. As a chamber, we are completely membership focused and membership based. So a lot of our revenue and a lot of our money that we use to drive services and create opportunities in the Shire comes from our membership base. So I certainly say thank you to all our members who have joined us today. And we certainly want to say thank you to all our members who have supported us during these uncertain times. And we're always looking for new members to come and join our chamber. Certainly we want to be the voice of business within the Sutherland Shire. And as a not-for-profit organisation, as I said, we rely heavily on membership funds to do so. So we run events. Obviously, when COVID wasn't a thing over the last 6 months or so, we've been able to get back to face-to-face. But since COVID and the lockdown, we've been able to pivot into virtual events. So we're certainly very passionate and very willing to continue to support our membership base. And we have a whole heap of online and virtual events coming up. Our next event is on the 12th of August, which is our traditional after 5 networking event where people can connect with other business owners. And the beauty of being virtual like it is today, that we can reach people beyond the Sutherland Shire. So certainly not restricted to people within the Shire, but businesses from other areas, people that would like to connect and socialise a little bit more during these uncertain times. We certainly welcome you to come along to our next event, which is on the 12th of August. you can get to our website at southernshirebusiness.com.au and you can register for other events. And we certainly would like to have more people come along and connect. As a psychologist, I can attest that during these times, you want to make sure that you are connecting with those around you, and particularly for those of us involved in businesses, making sure that you're staying connected with other people within your area and obviously within other businesses to keep your mental health and well-being connected and updated. And that'd be a really great opportunity for our chamber event. So thank you again to Craig, and thank you again to Jenny for the opportunity to be here this morning.
That's great. Thanks, Joel. We're proud to announce that this is the 11th year that we have brought this event to you. And I have to tell you, Craig hasn't changed a bit in that time.
That's not the case. That's not the case.
Craig has helped us to understand what the economy has in store for us to the best of his ability without a crystal ball. But I tell you, I think we need a crystal ball right now. As in past years, we've had a number of economic curveballs thrown our way. I think this year we're at a home run. What do you think? Craig James is CommSec's chief economist with a vision to present CommSec's research in a user-friendly way. Craig is a regular on TV, radio and newspaper. He writes regular commentaries as well as presenting to staff, to clients and to external organisations. We are very fortunate to have Craig with us today. I'm about to share Craig's presentation with us, and then Craig will share his economic insights this morning. Thank you, Craig.
Well, thank you very much. And there it is, waiting for the dawn. 12 months ago, I think I might have the opening slide about new dawn, sort of getting a little bit excited, I think, about, sort of the prospects for the economy. Now we're changed it to waiting for the dawn, so we're still positive that once we do get the domestic cases suppressed and we start moving forward, that we're going to see a sharp rebound. But the timing of this presentation couldn't be better. The reason being so that our CBA economics team has just put out some new forecasts for the economy. Just as minute or two ago, we had some new forecasts for the economy. Employment, is expected to now fall by 300,000. We're expecting a decline in the Australian economy in the September quarter, July, August, September, of 2.7%. An unemployment rate rising from 4.9% to 5.6%. And previously, we had expected to talk about the Australian economy recovering so much that the Reserve Bank would start increasing interest rates. And we were looking for that first increase in interest rates in basically, it's a bit over 12 months' time in November of 2022. Now we've pushed that back, understandably, to May of 2023. So certainly if there's a silver lining for those people who've got debt at the moment, the expectation is that what we're going to see is interest rates remaining unchanged for a long period of time. If you're a saver, so less positive in terms of that. But in terms of this presentation today, hopefully it won't run on too long, so you can sort of get some morning tea or breakfast or whatever the case may be. As is always the case with these presentations, we've seen the disclaimer slide. That was the previous one, the one we're on overview. I haven't whipped around, sort of Sydney or New South Wales to determine, what your own personal circumstances are. So this is very much of a general nature. The beauty of having that disclaimer slide in the presentation pack is the fact that Sullivan can share this. There's the disclaimer slide for all the compliance people and legal people. That's your slide, so that you like to see it, each and every time. Because that's attached to the pack, what we can do is enable you to see all the slides that we're producing today. So let me get into it. I've got so the slides here, so I'm looking at as well. You've got the slides sort of there. So hopefully sort of barring sort of the connection for the phone sort of cutting out, sort of we should all be good. I've even got sort of the phone being charged here. Now, a few years ago, you go back 4 or 5 years ago, I had an adage, sort of if you wanted to be seen as an expert on the economy, Somebody asks you an economic question, just answer China, and you can't go too far wrong. Well, nowadays, yes, you've got to answer every economic question with COVID-19 or perhaps the Delta variant. But certainly COVID, is really at the heart of, what's going on. We all know, about the lockdowns and then the border closures, and we do well for a period of time, then the virus, comes back, and then we move into lockdown. But I am confident that just like Victoria, we'll get out of the situation. It's just a matter of time. And once we do get out of the situation, we'll rebound quite smartly. It will be very, very important for the federal government, for the state government, and for the Reserve Bank to maintain stimulatory rate settings or stimulatory fiscal and monetary policy settings to ensure that we can get through this period of time. So we did have a lot of success in suppressing the virus, but Delta is a different animal, and hopefully we won't see new variants coming about which are even more infectious than the one we're seeing with Delta. What has been sort of really highlighted is the fact that it's important to get vaccinated. Now, if you haven't had your vaccinations, I encourage you to get out today and to get your vaccinations. There's plenty of AstraZeneca around the place. I got AstraZeneca for the 2 doses that I've had, so I'm fully inoculated. So encourage, and I'm still here to tell the tale. So AstraZeneca is not the demon sort of vaccine that a number of people see. Certainly, as I mentioned, so the stimulus should continue until we really well and truly get out of the situation. We have done very, very well in terms of supporting our businesses and in supporting our workers. The good news is the United States and China are driving forward, and they're driving the global economy forward. And I will talk about some of the issues that we're going to deal with today. Inflation, we have got the inflation figures coming out at 11:30 today, so that's super important to watch out for. We've also got this Delta, and see whether sort of we can get on top of that, and also vaccines. They're the key issues really at the moment. Moving on to the next slide, where are we headed? I thought I'd put effectively the conclusion right up the top of the slides. Now, there's 3 things that the Reserve Bank wants to see before it even thinks about lifting interest rates. The jobless rate is currently at 4.9%. The Reserve Bank wants to get that down to 4% before it can start saying, well, look, we're really moving forward. We're at full employment. Clearly, so we can start thinking about, sort of easing up in terms of the monetary policy settings. Inflation, 1.1% today. After today, it's probably going to be 3.7 or 3.8%, because we are coming off a lower base, but that was to be expected. Where the Reserve Bank wants to see inflation is between 2 and 3% on a sustainable basis, not this one-off impact like we're going to see today. And wage growth rising from 1.5% to 3%. So still a long way away from that. And that's your signpost. That's something to look out for going forward. If you saw 4% jobless rate, you saw inflation sustainably between 2 and 3%, wage growth around about 3%, the Reserve Bank would be thinking about lifting interest rates. And as I said, we had expected the Reserve Bank to start hiking rates in November 2022. We're now moved that out to May of 2023. So moving on to the next slide, that gives you a bit of some idea about what's happening in terms of the global economy. The International Monetary Fund has said in 2020, the economy contracted by 4.9%. Certainly a very, very big sort of fall in terms of the global economy in 2020. You've really got to go back to 1946 to see a bigger decline in terms of the economy. So this is like a war. After the First World War and after the Second World War, we saw this impact in terms of the economy. This time around, again, it's a similar impact in terms of a war on an invisible enemy rather than a visible enemy. The expectation is we will bounce back this year by 5.4%. And the expectation actually from the Commonwealth Bank economists is that we're actually going to do a little bit better than that, 6.8%. But we do have the United States and China driving their way forward. China this year might grow 8 or 9%. So that's just an extraordinary growth figure. And that's super important for us, of course, in Australia, because China is our major trading partner. And you can see the iron ore price continuing to sit above $200 a tonne. It's quite remarkable. The cost of production are probably something like $20 a tonne. So in the profit reporting season coming up, you're going to see bumper results from the likes of BHP, Rio Tinto, and also Fortescue, simply because China is demanding, and other nations around the world, demanding our iron ore to make steel for infrastructure type projects. Certainly, sort of that's beneficial for us here in Australia and beneficial for those major iron ore producers. Moving on to the next slide. This is entitled Australia, the Big Picture. And you can see what we've been able to achieve so far. The chart on the left-hand side is the rebound of the Australian economy. We did contract last year in the March and the June quarters. In fact, the June quarter downturn was 7%. But we've had the most amazing recovery in basically sort of 45 years. We've had 3.5% growth in the September quarter of last year, 3.2%, then 1.8%. So we are currently seeing annual output, so 1.1% above a year ago. So it shows that we've been able to do it beforehand. We've been able to rebound from the lows. We expected to be able to do the same again. What we may end up seeing, the shape of the recovery turn into a W rather than a V. So we've got that V shape likely to go down in terms of the September quarter. Then I think we'll bounce back later this year and into 2022. You can see what's happening with wages and prices, and that shows you the task ahead of the Reserve Bank. We've got 1.1% growth in terms of underlying inflation and 1.5% growth in terms of wages. And as I say, those are some of the things that we need to be able to focus on to be able to determine where we're going from the next slide. Well, hopefully you all picked up on the news this week. On Monday, we put out the State of the States report, always sort of well anticipated by treasuries around Australia, and also the opposition, sort of treasury spokesman, gives them a bit of a run too if the state's not travelling sort of too well. The things to highlight is the fact Tasmania is doing very, very well. Tasmania had been doing well before the lockdown, and it continues to do sort of very, very well. For the simple fact that the population growth continues to rise, growth of housing and demand for cars and retail spending and the like. And of course, Tasmania has also got the support coming from its splendid isolation, being an island. It's a little bit easier to be able to control some of the cases coming into Tasmania in the first place. So Tasmania is doing very well. I would contend that all the states and territories have done very, very well. You can see that in terms of the jobless rates. If you look at sort of Queensland and Tasmania, they've got unemployment at 12-year lows at the moment. Tasmania, South Australia has got an unemployment rate of 9-year lows. So right the way across Australia, we have seen that improvement in the job market, and we can thank JobKeeper and JobSeeker and super low interest rates, access to superannuation, a whole range of stimulus measures for us to be able to be in this great shape. But New South Wales has some challenges ahead. Where the strength is in New South Wales. In the interim is the fact that plenty of houses are being constructed at the moment, and the home prices are rising. That's adding to wealth levels for average individuals. We'll move on to the next slide, because this is really so the crux of the entire presentation, what's been happening in the jobless rate. As I say, where the Reserve Bank wants in unemployment is at 4%. So we're sitting at 4.9% at the moment. That's the best levels that we've seen in 10.5 years. So we've got to really sort of highlight the fact that we are starting from a pretty good base, moving into this second wave of the crisis here in New South Wales with the Delta variant. So the jobless rate has been improving. In fact, probably there'll be a number of you out there in the audience here sort of which have been sort of finding it hard to be able to get the people that you want. And that's been one of the big challenges with the borders closed, the foreign borders so closed, and to some extent the domestic borders closed. You just can't get the people that you want. So we've got job vacancies just off the best levels that we've seen in 12.5 years. So to some extent, it's a bit of a silver lining, those doors being closed overseas, because it means more and more domestic individuals, sort of really have to get jobs. It may be second or third choice for a lot of employers, but certainly the only resort is to be able to get people, sort of domestically. So we had expected to get that unemployment rate down to 4.5% by the end of this year and 4% by the end of 2022. But as I say, sort of those forecasts have changed today, and it looks like we'll see that unemployment rate back up to 5.6% before it starts coming down again. And as I say, we're in the hands of COVID. We're in the hands of Delta. We can come up with all these forecasts, but it's really up to us to suppress the virus and to get vaccinated, because that's basically our road out of this situation. We'll move on to the next slide. And of course, everyone wants to know what's happening in Sullivan Shire. So you can find out, what's happening in Tasmania, or what's happening in Orange in central New South Wales. But you really want to know what's happening in Sullivan Shire. Well, in the month of June, what we had is an unemployment rate at 4%. Now that sounds pretty good, but remember, of course, in the Shire, we've had unemployment rates a whole lot better than that, sort of just over a year or so ago. In fact, if we go back to mid-2019, what we had is an unemployment rate in the Shire around about 2%. We're now looking at 4%. So it has been, sort of more difficult time in the Shire for retailers, for manufacturers, for service type businesses. We've seen that unemployment rate, trending a little bit higher. Nothing to get too alarmed about, but certainly, I suppose if it was very, very tight, super tight conditions in the job market, now it's become a little bit more easy. One of the other things which I've highlighted today, and you can see that chart, I've used an index number. The index is 100, is April 2020. And what this measures is retail spending through Commonwealth Bank merchants. So one of the things that we have at the Commonwealth Bank is we have the ability to be able to track spending levels in different suburbs. We have different municipalities, and we also have it through industry sectors. So reach out to Stuart Carey. So I think he's on the line here today. Reach out to the Commonwealth Bank people, and they might be able to provide you with some insights about what's happening in terms of the Sullivan Shire or in terms of your industry. You can see what's happened in terms of how retail turnover in the Shire has bounced back significantly after the previous lockdown. At the moment, we're sitting around about 1.1% higher than retail spending of 12 months ago. So this is the June figure that we're highlighting, and it shows that while we're doing okay in the Shire, we could be doing a little bit better. So if you want to see how you're tracking compared with your competitors, reach out to the Commonwealth Bank. And so this big picture type data is something that all the banks, sort of all the businesses are getting hold of nowadays. And if it can provide you with greater insights to drive your business further, well then clearly, so it's achieving sort of very successful goals. Now we'll move on to the next slide and have a look at business more generally. Again, you can see how we rebounded significantly from the lows of last year. And in fact, if you look at the National Australia Bank Business Survey, I don't mind using the opposition, provided so the figures are right. Now, I think they are right, because we've got a couple of other business surveys that are showing sort of similar sort of thing. Manufacturing activity and services activity, according to purchasing managers, was at record highs up to a couple of months ago. We have seen a downturn. You'd expect that to occur. Now, again, it gets down to the fact that we just need to suppress the Delta variant. We need to get vaccinated, because that's our road out of this situation. But it just shows you that businesses had been doing well. You hear a lot of the stories in terms of television, and the radio about businesses going to the wall and the like. Hopefully that won't be the case in terms of New South Wales. Hopefully the support will be there from federal, state governments, and the Reserve Bank will keep interest rates super low. We'll do everything that we can to be able to support businesses through this situation. But it's not going to happen, so in the next week or so. In fact, according to the media, it could be another 4 weeks that we're in this situation. So you need to keep close to other businesses through the Sutherland Shire Business Chamber. Certainly that's something I wholly endorse, because It gets you connected to other businesses to be able to find out what's working for others and what's not working, and certainly connect to Sullivan Dewing to be able to make sure that you are entitled to get all the grants and all the money that you will get all the money that you're entitled to from the federal and the state governments. Let's move on to the next slide. And one of the interesting features in terms of the current situation is the amount of savings that are occurring in terms of the community. The chart on the left-hand side shows the net household saving, sort of figure, and you can see, sort of up to $2 trillion in terms of savings. Just quite a remarkable, sort of figure. Now, where did we get all this money from? Well, the stimulus is provided by federal and state governments to certainly to help. We've had some access to superannuation. Low interest rates basically means that we're saving a bit in terms of loan repayments, so we've got extra savings coming from there. And we're not travelling overseas. Have you noticed that? We're not travelling overseas, and as a result, we're saving from everybody sort of likes to get overseas, whether it's sort of Fiji for a local holiday or New Zealand, or whether it's over the other side of the world for the UK and the US. But if we're not making those trips, we can't really go anywhere at the moment. We're saving a bit of money. What we are doing is spending some of that money, and you can see how retail spending has been doing very, very well. Those retailers have had a very good connection in terms of their suppliers, had a very good online presence, have been the ones that have done very, very well. We had some profit result out from Temple and Webster. We know that they're basically an online furniture and floor coverings and rugs and the like, so they've been doing very, very well over the last 12 months because people have been getting online and buying those goods in, making sort of their little caves a whole lot better in this lockdown situation. So certainly there's been plenty of winners in terms of this lockdown period of time, particularly those retailers that have had good supply chains, and those sort of have been very, very good in terms of online presence as well. In fact, this may surprise you. Here's the latest figures on wealth. So the next slide is basically entitled Boom or Just a Recovery. I think I might have got a bit far ahead of myself by questioning whether we're in a boom. It just shows you this COVID situation can make what seems like credible forecasts somewhat uncredible, sort of over time, simply because we go into lockdown and the economy goes backwards for a period of time. But if you look at sort of wealth levels, wealth is at record highs, and of course we know that from the value of our home going up. We also know that from the value of the share market going up. The share market is at record highs. Home prices are at record highs. So you may not be feeling wealthy, but if you went to the figures, you'd see that we're actually doing sort of okay. Even so that used car that's sitting out in the garage, so your second or third sort of car, that's appreciated in value over the last 12 months. As strange as it may seem, appreciated in value basically because there's so much demand for cars at the moment, not enough supply coming onto the market, and that's pushed up the price. And everyone wants to drive themselves around rather than catch sort of public transport. You can see the returns that we've had in terms of shares and property over the last 12 months. 30% growth in terms of the share market over the last 12 months, and 15% total returns in terms of homes. So whether you own your home outright or whether you've got investment property, if you've got property exposure, you have been doing very, very well. Here's what I like to call a fun chart. Sort of you'd like to put something a little bit different in terms of the presentation. So the next slide says amazing times. What am I showing on the left-hand side? I'm showing new car sales figures of Porsche. So Porsche new sales over the last 12 months. So they're rolling annual totals. And up until last month, we had a bit of a dip last month, but the month before him, Porsche sales were at record highs. That's just quite remarkable. Record highs in terms of Porsche sales. And it wasn't Porsche, sort of Lexus sales were at record highs as well. And BMW, Rolls-Royce, Bentley, sort of all the upmarket makes have been doing very well. That's, of course, if you can buy the the cars because they've been fairly difficult to get cars into Australia because of lockdowns in other parts of the world. And there's that a chart that I was talking to or alluding to beforehand, used car prices. As I say, it's a case of supply and demand. People want to get cars to drive themselves around, perhaps a third car or a fourth car in terms of your garage or out in the street, because people are not wanting to travel on public transport. And but there's few of them on the market. Everyone's holding on to them, and it's forcing up the price quite remarkably. Let's go into the housing market, so a little bit more detail. And again, you can see, I'm representing the Sullivan Shire, there as well. So if we look at regional areas in New South Wales, prices are up 20% on a year ago. If we look at, in the capital city or in greater city region, up 15% on a year ago. And simply because job security has been improving. We've had grants to be able to buy new homes for first home buyers, so that's been helping the matter as well. And there's also another impact as well. A lot of people, in the last 12 or 18 months have said, well, my home is a bit too small, or I'm in an apartment. I really need extra space in this COVID environment. And some people, that creates demand for houses rather than apartments. The other thing that's been happening is that people are saying, look, I can work from anywhere. And as a result, said I'm going to set up my base now in Byron Bay or Mullumbimby, or, so there's places like that. And of course, with the technology, like we've seen today with Zoom, you can be able to do, a lot of things remotely. I'm here in my bunker in Huntley's Cove, and I've got a range of technology around the place to be able to do my job from home. And of course, I could be sitting in Byron Bay at the moment. That would be quite nice, wouldn't it? I could be sitting in Byron Bay and doing the same sort of presentation, and you'd be getting the same results. So that's why we're seeing the regional areas doing well. Sutherland Shire, you can see the median prices from CoreLogic, a bit over $1.3 million in terms of the median home price in the Shire, and 17% increase in home prices over the last 12 months. Certainly that may be feeling a little bit more chipper if you're in, your lockdown, bunker, this morning. Let's move on to the next slide in terms of housing activity. And you can see, as I mentioned, there's more homes that are being built at the moment. It gets down to the fact of, again, job security, super low interest rates. It gets down to the fact of people's, demand for assets in, this current environment. Particularly houses are being built, at the moment. As I say, greater demand for houses rather than apartments. This is happening right the way across Australia. You can see houses under construction, and that's for total Australia. The figures of in the current environment across Australia, more than 70,000 homes are currently, or houses, freestanding houses, are currently being built. So that is quite remarkable. Sydney is probably not seeing the same degree of activity as other parts. We've got something like 27 or 36-year highs for places like Tasmania and South Australia in terms of dwelling starts. New South Wales probably not rising to the same extent, but certainly there's a lot of activity out there. And of course, if you try to find a builder, get a builder or a tradesman, sort of in the current environment, they're pretty well, sort of worked hard at the moment. Whether you're building a house right from scratch, or whether you're doing some renovations, clearly those trades are in big demand at the moment, and probably will be in bigger demand, so the next week or so, when construction is allowed to resume again. Let's move on to the final part of the presentation. Let's talk about the interest rates, the share market, the Aussie dollar, and then finish up and go to some of the questions that you've got. The cash rate, well, super low interest rates. If I had told you a couple of years ago we're going to see close to zero interest rates, you probably would have looked at me and sort of scratched your head and you say, well, what planet are you on? But it has been quite remarkable. Interest rates at super low levels, and the Reserve Bank, their commitment to say we're going to do whatever it takes to be able to get this economy moving at the fastest pace possible. That's why they've constantly said it's going to be 2024 before they believe that we're in a position to be able to lift interest rates. So interest rates likely to remain low, and as I say, even Commonwealth Bank's forecast, we're pushed out to 2023 the next chance of a rate hike. So we could see another 18 months, 2 years perhaps, sort of before we start to see interest rates rise from levels which are close to zero. It's quite remarkable. The Aussie dollar, it doesn't get the same degree of coverage when people are not traveling overseas. And of course, for exporters and importers, it's still important. We've got the Aussie dollar around about 73.7 cents at the moment. One of the reasons it's being supported at relatively high levels is the fact that demand for commodities. So we're seeing commodity prices going gangbusters. Demand for our copper, for our iron ore, for our natural gas has been super strong to be able to fuel economic activity in other parts of the world. But one of the things that we have seen a little bit of slippage is in terms of our longer term interest rates compared with the United States and other parts of the world. So we're not seeing the same degree of attraction, and that's pulling on the Aussie dollar to some extent. The greenback has also been strong, and that's why we're sitting at 73 cents rather than sitting a little bit higher than where we should be at the current time given commodity prices. The share market, as I say, share market is at record highs. If you go back to June of last year, that may seem sort of quite remarkable, that we would be at these sorts of levels. You can see what happened, so when we went into lockdown, we moved from levels like 7,200, sort of mark for the share market down to 4,500. That's a 37% fall in the space of 20 days. It was just quite remarkable what happened in terms of the share market. But government came on its white horse, providing the stimulus to businesses, and as a result, people sort of maintained confidence. They continued to spend in lockdown, and business profitability has continued to rise. We are on the cusp of earnings season. As I say, Temple and Webster was one of those to report their earnings yesterday. We are going to see a rash of companies over the next few weeks. Certainly over all of August, we'll see a lot of major companies reporting their earnings results. That's super important for investors. That's super important if you're thinking about your superannuation money and what's likely to happen. What we are going to hear from a lot of companies is the fact that they've been doing very, very well in terms of the earnings that are coming through, particularly the retailers, the miners and the banks. Not so good news in terms of anything associated with travel, whether it's airlines or airports, and the utilities have also found it a little bit more difficult, so going forward as well. One of the things to watch out for is the guidance coming out from companies. In this sort of environment, if you were a CEO of a major company, would you be giving good, accurate guidance about where the company's headed? Well, it's a little bit difficult, isn't it? So in the current environment to be able to do that. So certainly that's something we might hear a degree of caution coming from CEOs over the next month or so. But the share market is in pretty good shape at the moment. One of the things that a lot of people focus on with the share market, the price earnings ratio, the valuations of the share market. We're sitting at 21 times earnings. That's quite a remarkable sort of level. We've only seen it a few times in the last 40 years that we've been at those sorts of levels. And we haven't been able to maintain a price earnings ratio at these sorts of levels. So what we're hoping is that the earnings that come through over the next couple of weeks justify the high valuations for the market, and we get that PE ratio down to a more normal figure of perhaps sort of 17, 18 times. The long-term average is a bit over 15. Certainly shares are very much back in favour at the moment. People are determining where the wisest place to put your money. A lot of people are saying, well, it's either the property market or the share market, and indeed the share market's getting a few more Guernseys given, so the fact, the simple terms, if you support businesses, if you support consumers and workers in this current environment, people will continue to go about their normal sorts of business, and as a result, the revenue keeps on coming in, the profits keep on coming in, and that justifies the share market valuations. Let's move on to the next slide now. And here's some of the current issues, and this is the big issue, isn't it? So the time, the vaccination rates. We're sitting, at a vaccination rate. It's a little bit higher than sort of this chart that I'm showing here. The latest figures, I believe, are showing around about 16 to 17% of the entire population here in Australia is vaccinated. We've still got a long way to go to a critical mass. We need to get up to arguably, sort of around about 50 or 60% before we can be feeling a lot more comfortable. And indeed, a number of people would say, you have to get up to really, you know, so 70 or 80% to be able to say, well, look, we're going to have no more lockdowns ever. We've got a herd suppression or herd number that's going to be able to support us, you know, so going forward. So this is one of the issues going forward. We need to get those vaccination rates, you know, so moving. It's in our hands to be able to do that, whether, you know, sort of in terms of ourselves or encouraging our friends and family and business colleagues as well to be able to go down the same path. The other thing that will be an issue over the next year or so is the fact that the border remains closed. And if the foreign border remains closed, that means it's going to continue to be hard to be able to get the workers that we need. We won't be able to travel overseas, so it affects the travel operators. It affects the education sector. It affects, you know, so the tourism sector. So certainly that's something to think about in terms of some of the companies that you're invested in. It may be in terms of your business or in terms of the businesses that you deal with, that closure of the border is going to have an impact. Certainly even in the housing market, it's going to eventually slow down demand for homes. So it is something to monitor very, very, very closely. And finally, next slide, the last slide. Everyone, you know, seems to wake up at this point at the time of the presentation. If you're in a bit of a slumber, you know, so now is the time to be able to spark up a little bit and, you know, so to be able to determine what all this means for your company, for your business, for your own personal situation. I usually say this right at the very start, but really the biggest question that you want answered, you know, so in terms of this economic information is something that you answer yourself. You've got to say, so what? What does this mean? What does this mean for my customers, clients? What does it mean for my friends and family? When you ask that question, then you get some decisions that you want to make. You know, so should you be upping your superannuation contributions? Should you be paring back in terms of that? Should you be buying property or selling property? Should you be linking with other supply groups around the place? Should you be looking at your online offering? All those sorts of things get thrown up by, I think, economic presentation, or at least I hope that's got you thinking about some of the things that, you know, sort of could be important in terms of your situation. These forecasts, well, clearly they're rubbish now. They're more than 24 hours, you know, sort of old. And as I say, there will be a new group of forecasts that are coming through. So watch out for blurbs from CommSec as well as Commonwealth Bank, and watch out for the media, and it'll tell you our current view in terms of the economy. We still believe that 2022 is going to be a very good year in terms of growth. We had expected the same for 2021, and it had been looking very, very good, but of course the Delta variant has changed all that, you know, so in a big sort of way. We'll have to see what the future holds with the suppression of Delta as well as vaccine, because if we're doing any forecasting at the moment, those are the two things that we're primarily focused on to be able to determine, you know, so where we go from here. I'll leave it at that. Thank you very much. No technical issues so far this morning. We cross our fingers. Perhaps I've just spoken too soon, but I'll just leave it up to question time.
Thank you, Craig. That's great. Some really good insights there for us this morning. So we've got a number of questions coming through that you've typed in today, and I've got a number that have been submitted beforehand. If I might start off, Craig. So you mentioned home prices had increased 17% in the last 12 months, and on Monday, NAB came out with their quarterly Australian residential property survey, which mentions that they're predicting the growth for this financial year to be 19% in residential property, and then a further 4% in 2022. So when you think about investors and homeowners, should they, because there's a lot of people looking to be buying property, we're having a lot of conversations with clients about that at the minute, and certainly I can't say when we have ever submitted more lots of financial statements to mortgage brokers and banks than we have in the past little while. So we know there's a lot of activity in this sector. What are your thoughts? Should people now be waiting if prices are expected to level out in 2022?
Well, certainly if you asked me the same question 12 months ago, you know, sort of the answer would have been yes, you know, sort of property is headed for some pretty spectacular times, because 12 months ago, what we're talking about is the super low interest rates. We're talking about the fact that the job market had been holding up, you know, so quite nicely. We've had, you know, sort of government support, you know, sort of coming through. the home building sort of type packages, and state governments and territory governments have been similar sorts of things. So had been our forecast, sort of over the last year or so, that we were going to see something like a 10 or 15% increase in property. In some parts of Australia, certainly it has been doing better than that. As I say, so the Shire up 17%, and regional New South Wales up in the order of 20%. But I think going forward, certainly we're not going to see the same sort of degree of growth in terms of home prices, because effectively we've got valuations now at much higher levels. Interest rates can't go too much further, can they? Sort of when you're at zero. So that's all basically factored in. I think the job market will continue to improve once we get over this current second wave in terms of COVID. But one of the things going forward is it's a matter of demand and supply. We've got a lot of homes, and particularly freestanding houses, coming onto the market. We've got the closure of the borders as well. And that, I think, is part of the reason why National Australia Bank has been saying next year look for 4 or 5% growth in terms of the home prices, rather than 15 or 20%. So it's always a matter of supply and demand. I think a lot of the pent-up demand has already come through. Interest rates will remain supportive. I think the job market will remain supportive. And we can't rule out that, see, if the times do get tough, that there'll be even more support payments by the government. But, so moving forward, we don't have the foreigners coming to Australia. Whatever that's the case, demand for property will be a little bit, on the lower side. As I say, that supply coming on in terms of new home building as well. So I think 4 or 5% growth in terms of home prices in the next 12 months is a pretty reasonable assumption.
Yeah, absolutely, and interesting that it's that there's no prediction on really a pullback in the property prices, more a stabilisation.
Yeah, we will get the figures from CoreLogic coming out next week. So I think they're come out on Monday. So the latest figures will come out there. We get from CoreLogic the regional prices. So we should be able to represent that in terms of our economic report. So if you go to the CommSec website, you'll be able to get a copy of our economic report, and it may be on the CoreLogic website as well. So what's happening in terms of the regions. But what we have identified over the last few weeks is there has been a slowdown in terms of the rate of appreciation of houses, particularly in places like New South Wales. So certainly, sort of COVID has had a depressing impact in terms of people's willingness to go out there and buy more homes.
Yeah, absolutely. So a question from Jared. With the RBA out of the market, do you see APRA trying to control property prices and adding lending restrictions on financial institutions?
I think what it'll be is a continued close watch in terms of the lenders to make sure that they're doing the right things in terms of assessing people's ability to make the repayments. They're looking very, very closely at the true value of people's sort of balance sheets. But it's a totally different situation for a few years ago, when investors were really riding roughshod on the market and driving first home buyers out. So they're going to be watching very, very closely the re-emergence from investors. We know that investors are have been getting a little bit more active in terms of the market, but I think the first thing they need to do is just to make sure, touch base with all the finance providers, that they are doing the right things, that we're not seeing an increase in insolvencies around the place, and that all the proper mechanisms have been put in place by the lenders to ensure that so people are making or will be making the repayments. We may have.
I can certainly say from our point of view, there's a huge demand on letters of assurance for various factors of the financial statements, and there's a much deeper analysis seeming to be done by the banks and the financial institutions at the minute before they're approving the lending.
Yeah, and that's what you would expect, sort of a fairly sort of bubbly sort of market as we have at the moment. Just got to make sure all the propositions that are being put forward are indeed right and true propositions.
100%. Okay, question from George. What is the timeline on the goal for wages? So the wages issue comes up all the time with clients when we're running meetings and in general conversations. And And certainly the challenge is not only skilled workers, but getting the workers that businesses need. So obviously with the border closures, this puts even further pressure on that. So the businesses were feeling this pressure before all these border closures, and and certainly some great challenges there now. So there's two things to think about. So there's the wages growth to think about, as well as the ability for employers to actually find the people that they need. So what's your timing first on the wages growth?
Well, the Reserve Bank had this expectation of 2024 that all the conditions would be in place to be able to lift interest rates. So we've got 1.5% growth in wages at the moment. They said, well, it's going to take some time for supply and demand to really sort of create a situation where we've got 3% wage growth. And that's why they thought it'll be 2024 before we start to see that. What the general view was is in terms of stimulus being provided to the economy, that it would take that long for activity to generate the amount of jobs that were required and get that unemployment rate down to 4%. And if we're getting down to 4%, sort of full employment, so then we start to see, sort of this demand for labour exceeding supply in a much more generalised, sense. That pushes up wages and therefore pushes up prices. So our view had always been that the Reserve Bank had been a little bit conservative in terms of their forecast, and I think they would, so highlight that as well. But they would also highlight the fact that things can come around the place, like Delta, which can change these forecasts quite significantly. So we're of the view that the job market has tightened. It's probably going to ease a little bit after this Delta situation, and as I say, unemployment moving from 4.9 to 5.6%. Then it's going to take some time to again get that back down to 4%. So we had expected rates. We had expected the requirements for interest rates to go up to be satisfied by the end of 2022. Now we've pushed that out to May of 2023. So May of 2023 is when we think that we'll see wage growth across the economy more generally, broadly, around about 3%. We'll see an unemployment rate of 4%, and we'll see inflation between 2 and 3%.
Yeah, understand. So certainly one thing that we are seeing with employers is that they are getting a lot more creative on ways to fill their workforce. And even interestingly, I heard a report recently about the ANZ Bank looking at recruiting over 50s for additional life experience, because they obviously are looking for workers as well. So that's what I would be encouraging businesses to do. Think creatively about how you can solve those employment issues in your business. Another question from George. Relating to the cost of raw materials trend, will increase the cost of building by approximately 4%, and what will this do to investments? So George is talking about the cost of raw materials increasing and what that's going to do to the value of our investments.
It's a question of whether that we have got a number of potentially inflationary situations, sort of in different sectors of the market, particularly in terms of the building sector, where you've got everyone wanting to make their renovations at the moment, everyone wanting to build houses, and there's only so much supply of raw materials there. So we're seeing that short-term impacted, but as I say, I mean, these home building is not going to go on forever. I think what we are going to see probably in around about, sort of 6 to 9 months' time, we're going to see cooler levels of activity in terms of the housing market. And we're going to see, sort of more reasonable, sort of levels in terms of raw material, sort of prices. But as is always the case, it's a matter of supply and demand at the moment. Every man and his dog wants to build or renovate, sort of the home. And there's only so much raw materials to be able to go around. Of course, building material supply, this is a great time to be had, because both demand and prices are rising in the current environment. When you think about some of the biggest share market, how they've been doing us as well. BlueScope Steel has been one. So when we think of construction more generally, certainly, so that's the impact. Sorry, I just had my computer was about to go off. Lost my train of thought then.
Yeah, so that leads me to my next question, actually. So the construction industry certainly has been an industry that has fueled our economy for a little while. So where do you see our growth coming from at the end of the construction boom?
Well, certainly, I think there's going to be a number of. It's a stage of looking at the timing of these things, so moving through. So for the next 12 months or so next 12 months, construction is going to be super strong. It's not just home building; it's in terms of infrastructure type building, sort of as well. We know all the states and territory and the federal government have got sort of big plans in terms of infrastructure spending. So over the next year or so, certainly things are going to continue to be driving forward. We should get in 12 months' time cooling down in terms of the housing market, and we would think so once we move into 2022, by this time of next year, we'll have the vaccination rates up to such a level where the foreign borders are being opened. And that could create a bit of a second wave in terms of demand for homes if more migrants come in to fill the job vacancies, where the significant job vacancies which are around the place. The infrastructure building, I think, is going to, when we're talking about building, sort of roads and schools and hospitals and the like, it's not a 6-month development, it's not a 12-month development. What we're talking about over a longer period of time, and there are significant infrastructure plans, as I say, from state, territory, and federal, sort of government. So I think that's going to remain strong for quite some time. But differences in terms of the timing of particularly the home building sector. It's going to be really interesting in commercial construction when we get back to a degree of normality. So how many people will decide to continue to work from home and to continue to buy things off the internet? So what does that mean for retail construction? What does that mean for office construction? And I think we are going to see a degree of softness in terms of the new activity in both those areas for a little while as people sort of work out so what will be the new normal in a longer term basis. I think for a lot of people, even for myself, working a couple of days at home is not such a bad thing. And do you need to have all the chairs and tables, sort of the offices, if people sort of working from home on a more regular basis?
Yeah, absolutely. I can tell you our offices here are very lean and stripped of monitors. They've all gone into homes to be plugged into laptops. If I can turn the questions now to more share market related. So first question is, how does the high Australian P to E ratios compare with the US and other global share markets?
We are seeing PE ratios high right the way across the globe. And what we're going to really, I suppose, understand in terms of the price earnings ratios is if you're trying to generate returns on your money at the moment, where do you put so that money? You can't really leave it in the bank and get super so normal returns. In terms of the housing market, certainly there's ebbs and flows in terms of the housing market as well. But the share market is one place, particularly with the stimulus being provided by federal and state governments and governments across the globe. So that's where you're going to get the return. So if we look at the United States, it was a bit of a dip, overnight, but from record highs. So the US has been at record highs. European markets have been record highs. Australian share market has been at record highs. So these PE ratios, the longer term average in Australia is around about 15.7 times, and a similar sort of thing right the way across the globe. But I think what we're going to have to probably see in the next couple of years is higher PE ratios than what we would have seen in the past. And that's simply because interest rates are near zero. When you've got near zero interest rates, you've got to put your money to work in the share market. And that means your price earnings ratio by the very nature are going to be a little bit higher than in the past. I think there's a new normal that's going to come in terms of PE ratios. So continue to look very, very closely about companies, about their earnings levels and about their expected earnings levels. Continue to make the right question marks, but don't get too shocked by the fact that you've got PE ratios up around about 21 times. This thing, not just here in Australia, but across the globe, and it's a function of super low interest rates.
Yeah, and so as we move out of COVID, what are your thoughts on the sectors of the share market that might perform better than others?
Well, I think when we do see COVID, sort of finally ending, and the borders start opening, I think people are sitting in their homes at the moment saying, when's the time going to be for me to be able to go to the US, go to Italy, go to Spain, sort of, as soon as the borders are open, we're going to see a flood of people, sort of going out the door and saying, sort of, I just need that, sort of break away from home, that break away from Australia. And I think the travel sector is certainly going to be a big beneficiary to that. When the foreign borders are open, I think it's a case of education, providers, tourism, sort of providers, that certainly will see the benefit, so coming through. I think we will continue to see strength in terms of mining operations, because infrastructure, as I say, you can't turn it on and turn it off in a second. Sort of, it takes time for these projects to wind off, and we've got countries around the world wanting to drive their economies forward. That means infrastructure spending. So I think we're going to see mining good for a period of time. Be selective in terms of retailing. There's good operators around the place, and there's ones which are lead a little bit more work, particularly in terms of their supply chains, particularly in terms of their online presence. So we've got companies like JB Hi-Fi continuing to shoot the lights out. Be a bit more selective in the retail sector, because not all of those can do well. And as we see the borders open up and people travelling overseas, we are going to see less money going into retail here in Australia. So that will provide some challenges for retailers.
Absolutely. So we can see that the share market has risen strongly, which has been fantastic, certainly for people's superannuation. And I had a look back at last year's predictions, and we were thinking that by June 21 we'd have the share market at 6,600, and I think it closed yesterday at 7,700. So it certainly has been buoyant, there's no doubt. So you're predicting this to be about 7,500 by June next year. So are you suggesting that it's now had its best growth for a little while?
We had been expecting a correction to come through. Certainly, the last 12 months, we've seen 30% total returns on the share market, something like 26% per share prices, so by itself. You generally not see, so 2 or 3 years in a row that you see that sort of growth. So that's why we're talking about more modest growth over the next 12 months. We have been fairly conservative in terms of our forecast. As you see, in terms of the predictions, as you mentioned, 74, 75 was our prediction by June of 2022. Well, we could, sort of see those sorts of levels more consistently in the next few months rather than 12 months ago. But we're always got to be, sort of on the lookout for new ways of the virus, so coming through. We're always got to be on the lookout for the fact that once things start to settle down a bit, sort of we'll start to see people, sort of again looking a little bit more closely at these valuation levels. And if interest rates are going to start rising, then certainly the share market won't be held in the same sort of context going forward. I think a lot of this has been to the fact that we had expected some interest rate increase speculation to start to be generating, sort of over the second half of this year and into 2022. Of course, we'll continue to watch that fairly carefully, but when we start to see talk about higher interest rates coming through, we would see a period of time where the share market moves more sideways rather than up.
Yeah, understand. So last question on the investing side, best performer over the next 3 years, shares or property?
I tend not to think, sort of in one or the other. I tend to think that you look at both at the same time, because really, if you've got a bit of property, you've got a bit of investment in the share market, either through superannuation or directly, you're covering both of the major asset classes. So if one's going up, the other one, sort of tends to outperform. And through the presentation, if you go back through the slides, you'll see, so that happens over time. The ebbs and flows of the growth in terms of asset prices. I wouldn't be selecting one, so over the other. There's challenges ahead for both, and there's good prospects for both. And you just need to determine what your own personal situation is. Maybe overexposed to at the moment in terms of the property sector. You might say, well, I've got already significant exposure in terms of property. Why don't I take a little bit more in terms of shares? So it tends to be a more individual situation.
Yeah, absolutely. And I would say, we look after a lot of self-managed super funds here, and I would say the ones that do perform the best have a combination of property and shares.
Yes.
Little bit of cash as well, but certainly then they can take the rises and the falls on both the sectors, certainly. Let me move to a couple of other questions. Question from Brad. Excellent presentation, Craig. Well done, Craig. Good job. Times are good from an economic perspective and consumer confidence is high across the board. This has pushed the property market to current record levels, but the concern is the current household debt to income ratio. Where does this sit, and is it affordable or sustainable? Are we setting ourselves up for a future crash with debt levels ballooning?
Well, when we think about household debt, we've got to remember that there's another side to the equation, which is household assets. So debt's been rising. More people have been borrowing, and particularly borrowing to buy homes. So we're taking on sort of more debt, but we're taking on debt at super low interest rates, and we're buying assets that have appreciated significantly in price. So if in the last 12 months, basically you went out and bought an investment property that increased by, and you'd taken on sort of a bit more debt, the value of that asset may have gone up by 15%. The value of your debt or your debt repayments certainly haven't gone up by 15%. So I think what we need to be thinking about is in terms of serviceability rather than anything else. That's the way that financial institutions such as the Commonwealth Bank think about things in terms of serviceability, and provided sort of if interest rates start rising, clearly so there will be so less inclined for people to take on more debt, and that's going to affect the asset prices as well. But there's two aspects to it. Household assets compared with income are at record highs. The household debt may be at record highs, but it's a very small, much smaller component, sort of our balance sheet than household assets. And serviceability is the main thing that we need to be thinking about, provided so the loan can be serviced well, and you've done your homework in terms of the going forward in terms of interest rate increases, and you've done so your assessment. We do know the financial institutions always do that. It may be a 2 or 3% interest rate that you're charging at the moment, but when the bank does assess your ability to be able to service that loan, clearly they're putting interest rates 3, 4, 5 percentage points higher to make sure that you're able to achieve that objective.
Yeah, understand. I'll just take a last couple of questions. I do have a few more here, but in the interest of not keeping you too long today, a question from Gary. What will the hit to GST look like for the federal government, and can we get the 30 million for Queensland?
I'm not sure about it. In terms of GST levels, so clearly that's been dependent on retail spending. Retail spending has been going.
I think you mean, sorry, the 13 mil for quarantine.
Yeah, certainly. There's ebbs and flows over time. When you go into lockdown period, so there's some retailers that do very, very well, the online retailers, but clearly the clothing shops are so closed, and homeware places and the like. So you may be buying more of your goods online rather than sort of face to face. It's the service businesses that you really feel for at the moment, because you can't go out to a restaurant, so clearly at the moment. So, and you can't, unless you can really sort of get your money coming through from the takeaway, you are sort of going backwards to some extent. So in terms of GST, we do know that retail spending continues to remain, or the growth rate continues to remain pretty good. That's because people are in lockdown, they can't travel overseas, they are continuing to spend, and their income levels are being supported by government support payments. So provided the government continue to provide active levels of support, such as JobKeeper type payments, job seeker sort of payments, then people will continue to spend, and those GST funds will continue to roll through. Of course, once lockdown ends, we see a much more significant rise in retail spending as well. So these things tend to catch up over time.
Absolutely. Okay, let's have our last question for today, and let's move back to China. We haven't spent much time on China today, so there's a couple of sort of different points have been raised on China. So if trade tensions continue, where will we be looking to replacement markets, particularly for iron ore?
I think in terms of iron ore, there's a few places around the world where you can get your iron ore. You basically got to get it from Brazil or Australia, and they've had a few production sort of difficulties in places like Brazil with Vale. So China perhaps sort of doesn't want prices to be so high, but the bottom line is there's a limited amount of suppliers, and not just China wants to build things, you know, at home, builds the infrastructure. There's other parts of the world that want to build things as well. As I say, it gets down to infrastructure. If you what needs steel to be able to build roads and bridges and dams and even things like hospitals and schools, you're going to need steel. You're going to need the raw material being iron ore, and you're going to get that from Australia more than likely, or from Brazil. We do think that the supplies will increase from Brazil over the next 18 months, and we had expected that by the end of this year we would see $170 per tonne for iron ore, down from 200, and in 12 months' time we're looking at around about $130 a tonne. Now, the federal government's still assuming levels like $50 a tonne, remembering the cost of production is 20. So these are super normal times. Certainly good for the major Australian companies to be celebrating these current times and making getting all the benefits that they can, you know, out of this current situation, because it's not going to last forever. That iron ore price will come down as more suppliers come onto the market. And as I say, the short-term constraints in places like for Vale in Brazil, we think are going to be alleviated. We're going to see more supply on the market, and that will push down, yes, the iron ore price.
Yeah, absolutely. And just finally on trade relations with China, what are your thoughts there?
Yes, it's an evolving situation. I think what we've been very good at in Australia is we've recognised the fact that we need to modify our supply chains. We're going to need to make sure that we are widening our list of buyers and sellers. And so far, I think a number of businesses have been quite successful doing that. If we think about the wine area, China has been our major demander of wine, but we've been able to be quite successful in terms of sending more product into places like Europe, the United States, and the UK. So it gets down to how well the industry, how well individual businesses diversify their supply chains, both, you know, sort of in terms of purchases as well as sales. So
diversification is the key. Don't rely on one customer.
And that's always the case, isn't it? Whether it's domestic or whether you want to make sure that you have got a good diversification of your offerings.
Yeah, absolutely. Well, I would say thank you, everybody. We'll wrap up now for this morning. Thank you for joining us. I would thank Craig for your brilliant economic update as usual. It's very insightful for us and very important for us to stay on top of these numbers for our businesses as well as our personal situation. Thank you, Joel, for your input today from the Business Chamber. And I would wish everybody a very happy day. We will send a copy of the presentation out to all the attendees. And if there are any further questions, just let us know. But thank you very much, everyone, for joining us. Thank you, Joel. Thank you, Craig.
Thank you.
Thanks, Jenny.
Stay safe and stay strong.